Okay, here we go. A warm welcome to Timbro here in Stockholm. I'm Björn Hasselgren and I'm senior fellow here at Timbro, among other things, but this is the role I have today. We are having this seminar around the financial markets, and in brilliant English it says, has the regulation of financial markets gone too long? And in Swedish, har regleringen av finansmarknaderna gått för långt? We are having this seminar in English. To start with, three things. We are broadcasting this on the internet. It will be possible to see on YouTube later on, so that you know this. When we are opening later on for comments from the audience, we'd like you to use the mic. I will come out with the mic, and it's good if you present yourself, your name and possible affiliation. Of course, we like you to use Twitter, and if you tweet, you have the hashtag and then Timbro to connect to the flow of tweets that we expect. So we are happy to present Larry White, professor in economics from George Mason University, Virginia, USA, who is our main speaker today. We also have two commentators. It's Mr. Per Hortlund from the Swedish Institute of Retail, HUI Research, in some kind of English. We have also Mrs. Ann-Marie Pålsson from Lund University. Per and Ann-Marie will be invited later on to comment on Larry's presentation. Larry has an affiliation to George Mason University, where he's professor of economics, and you teach monetary theory and policy, and you have published extensively in these areas. I know that you also are or have been affiliated to the Cato Institute, and among the high number of books that you have published, I noticed two of them. One from 2009 was about free banking in England, 1800s to 1845, an interesting subject. I think I'm interested in economic history. And your most recent book, I think, is The Clash of Economic Ideas from 2012. But today we are focusing more on free banking and deregulation as a theme, and there was a Cato Journal article from 2013, I think, around an anti-fragile banking and monetary system, which I thought was very interesting, and Larry will give us a presentation around that theme. Per Hortlund has done research on free banking as well. He published a book in 2003 at Timbro around free banking, and I know that you have been working together with Larry also in research. Ann-Marie Pålsson, you have such a long list of experiences, member of parliament, researcher in economics, experience from the financial sector, board memberships in a number of companies. You are also debating both parliamentary and democratic things and also financial regulation. So I really look forward to this discussion. We start out with Larry, and then we will invite Per and Ann-Marie, and then questions from the audience. Thank you. Please.
Thank you, Björn. So Björn's asked me to talk about the themes of a paper he mentioned, the title of which is Anti-Fragile Banking and Monetary Systems. And the term anti-fragile is one I borrow from Nicholas Taleb, who had a book entitled Anti-Fragility. And the concept is fairly simple. We all know what fragile means, something that breaks easily. You can't even put a little bit of stress on it without it falling apart. Anti-fragile is a property of something that actually improves under moderate stress. So we go to the gym and exercise because our muscles improve if we put them through a little bit of stress. And you can think of robustness as the property of not being affected either way by moderate stresses, but anti-fragile systems grow stronger. So that's the kind of banking system we would like to have. And I want to argue that under different institutional circumstances, under greater liberty in banking, we historically did have anti-fragile banking systems, and it would be nice to move in that direction from our current system. To make a local connection, I want to start with an interview with the CEO of Nordea Bank, Christian Clausen, who's been outspoken against excessive capital requirements on banks, complaining about how it's choking off lending to small businesses, because if he wants to lend to small businesses, the regulators tell him he has to hold so much capital against those loans that it makes it very expensive for the bank to make those loans, and he says he has to charge 6 to 7 percentage points higher to small businesses. But then he says the attitude of the regulators is that the only purpose of, this is a quote now, the only purpose of banking is to stop banks from going bankrupt. He says, but there's a much cheaper way of avoiding a financial crisis than having these high capital rules. And that is that the politicians should take the responsibility to avoid asset bubbles, because they are in reality creating them. So what we would like is a banking system that doesn't just prevent bubbles by suppressing banking. We want a system that mixes abundant intermediation with systemic anti-fragility, or robustness if you just want it to maintain itself under stresses. And it's in a market that we get this kind of mix of innovation and discipline. But we're now in a heavily regulated system in which the regulators seesaw back and forth between encouraging one thing and then encouraging another. And right now they're encouraging stability at the expense of letting banks do what they do to intermediate savings into loanable funds. So many economists have grown up under the instruction of models according to which banking is inherently fragile. And this is a common view even among fairly market-friendly economists, and I quote Robert Lucas in the paper as saying that any fractional reserve banking system is just a house of cards waiting to collapse. And if that's your view of banking, then if you want the banking system to survive, then government has to come in and backstop it somehow. But really, that's a very peculiar view of banking. It's completely anti-historical, because fractional reserve banking systems originated, well, we know that they go back as far as 1200 AD, and they survived until about 1900 AD before governments took any concern with backstopping them, with protecting bank customers against bank failures. So it can't be that the banking system is that fragile, or it would have disappeared centuries ago. But the standard model that economists deal with, the so-called Diamond-Dybvig model after the two authors, depicts a very fragile bank, but it's, as I'm saying, it's a completely ahistorical picture. Now, Diamond and Dybvig are both Americans, so maybe they were just looking at American experience. In the decades before the Federal Reserve Act, there were several financial panics in which lots of banks failed. But that was not inherent to the system. That was because of restrictions on the banks that made them fragile, that restricted their ability to cope with extraordinary demands on them. There were laws against issuing more notes when the customers wanted more notes, and that meant that the customers would instead take reserves out of the vault, and then the banks would fail. All they had to do was look north to Canada to see a system that was robust, if not anti-fragile, a system where there were no financial panics, because the banks were well diversified and were not restricted from switching between note liabilities and deposit liabilities. Were not restricted from branching across the country the way banks in the US were. They might also have looked at Sweden, where you had the experience of the Enskilda banks, who remarkably imposed no losses on depositors in at least a century of operation before they were legally suppressed, and I think Per will say more about them. So this view that banking is naturally fragile is ahistorical and really anti-Darwinian, if you think about it, that a system that is prone to crumbling should survive for so long. But we made banking fragile in the United States and in England and some other places by imposing restrictions on banks that restricted their capitalization or their branching or their ability to meet extraordinary demands for currency. That was in the 18th and 19th centuries. Today, we make banks weak by giving them privileges that create moral hazard. We've protected banks against runs by deposit insurance and too big to fail, and subsidized lending facilities from the central bank so that banks aren't so concerned about keeping any more liquidity or any more capital than the regulators demand of them. And when the regulators demand too much of them, then they complain, of course, but they're not sort of managing their own liquidity and capital positions in a responsible way. One of the longest lived and most successful free banking systems, where banks issued their own notes subject to no entry restrictions, no restrictions on note issue, no capital requirements, was in Scotland. The title of the book I did was actually Free Banking in Britain, because it was in Scotland that you had free banking, and in England you didn't, but there was a debate over whether to have it. There was a famous episode of a huge bank crash in Adam Smith's day, a bank called the Ayr Bank, which is kind of a pun in English, but it's A-Y-R. It was in Ayrshire. It was run by people who didn't really know what they were doing, but they made an awful lot of loans. When the loans started not being paid back, they were in trouble. They started borrowing desperately and eventually had to give it up and crashed in a spectacular way. Adam Smith actually talks about the Ayr Bank in The Wealth of Nations. There's a new book about the Ayr Bank crisis by Tyler Goodspeed, and the title of the book is Legislating Instability, because Goodspeed makes the point that legal restrictions were imposed on Scottish banks in 1765 that weakened the Ayr Bank's ability and the ability of other banks to make themselves robust. But Goodspeed goes on to argue that if you look at the recovery of the system after the Ayr Bank crisis, well, these are, I'm putting it in my terms, it exhibits a kind of anti-fragility. There's a report published documenting everything the Ayr Bank did wrong that became kind of a Bible for Scottish bankers after that. How not to get into trouble, don't do what the Ayr Bank did. And there were many fewer complaints about irresponsible banking in the century after the Ayr Bank failure. So they learned from their mistakes. Deposit insurance was introduced as a kind of makeshift policy to provide a safety net for depositors. But the problem with safety nets is moral hazard, of course, and there's been a great deal of moral hazard in the U.S. banking system. Other countries have adopted deposit insurance in the U.S. in the 1930s, other countries in later decades, until finally it's hard to find a major nation that doesn't have deposit insurance now. And it looked like a free lunch. It looked like deposit insurance had this benefit of stopping bank runs in fragile banking systems without any cost, but the cost has begun to come home to roost. Deposit insurance, and beyond that, declaring even the uninsured depositors protected under what's called too big to fail policy, has meant that depositors no longer shop around for a safe bank, and so banks have much less incentive to be safe. And they've taken the kind of risks that we saw revealed by the crash in 2007, 2008. So we've weakened the banks by legal privileges, as I said, not just in the US, but also in Europe. So deposit insurance and too big to fail subsidize risk-taking. And in response to that, in response to the obvious incentive for banks to take too many risks, what do regulators do? Not reintroduce responsibility on the bank or on the depositors, but instead they want to regulate the bank's portfolios. And bank regulators are smart people, but they're not that smart. The banks hire people who figure out whose job it is to figure out loopholes in any particular set of regulations and arbitrage so that they take full advantage of their safety net. They sort of maximize the option value of the protection against failure. So there's an ongoing game being played between regulators trying to limit portfolio risks and bankers trying to exploit the subsidy to taking risk. And in that kind of environment, you get many banks subject to the same legal restrictions or regulations, piling into the same kinds of investments that seem to arbitrage the regulations. One example I talk about in the paper from the 19th century US is probably not so interesting, but recent example, the Basel capital requirements put a zero risk weight on sovereign debt. So if you want a high yielding asset that doesn't require you to hold any capital against it, buy Greek government bonds. The capital requirements say that they're perfectly safe, so that's how you maximize the return on your portfolio without having to raise any expensive capital. And so we had especially French and German banks piling up on Greek debt, which turned out not to be risk-free. Surprise, surprise. So what we would like is for banks not to avoid all risks. We want banks to take promising risks. Sometimes those risks turn out on the downside, in which case banks should be prepared to absorb their own losses, not to put the losses on other banks or on taxpayers. And so I think the Basel Accords are moving in the wrong direction. We need a system with a greater diversity of banks, more experimentation, more trial and error. It's okay for a bank to fail if the system itself doesn't entirely fail. If one bank fails, that's fine, as long as the rest of the system is not doing exactly the same thing that that bank was doing, and so the system does well. So Taleb uses a kind of ecological analogy. What we want is a diversified ecosystem of banks, because if we have a monoculture, like having a field planted in just one crop, a single bug can wipe out the entire crop. Right? Whereas if you have a diversified array of strategies, then you may lose some of your crop, but the rest of it will be okay. And if it develops an immunity to that bug, actually anti-fragile. So we want less centralization, we want more decentralization, we want less safety net and more responsibility on the part of bank shareholders and bank customers. So I'll stop there and take comments.
Okay, you can stay here, Larry. So
Yep.
I think I just have two questions or so. One interesting thing is, of course, in a situation where we have the feeling that the regulatory framework has been raised again in Sweden and in many other countries following the financial crisis, and also in the situation where Sweden's financial system or sector is growing and becoming more and more important. You wonder if you share your view, and I think you are basically right. How do you get from the present situation to a more deregulated situation? Do you have any comments on that?
Well, the first thing is to make sure that no bank is too big to fail. So that given an inherited situation where you may have overconcentration in a few banks, I'm on board with attempts to have banks write living wills, so-called, so that they can be resolved in the event of an insolvency. They can be resolved promptly without, causing a lot of freeze up in the financial system. But we've created a kind of subsidy to large banking by making large banks too big to fail, but small banks it's okay to fail. So we need to peel back in some credible way the guarantee against failure that large banks have or think they have or may be tempted to think they have, and make a credible commitment that nobody's too large to rescue, so that we worry about preserving the rest of the system but not any particular institution. And ultimately, I would like to roll back deposit insurance. Now, that's a complicated task. It's been compared to a bomb where you don't want to clip the wrong wires first, right? So I wouldn't say repeal deposit insurance tomorrow, because you'd have runs on the banks tomorrow afternoon. But give the banks a warning that they need to find alternative mechanisms to reassure depositors. And in the days before deposit insurance, banks had mechanisms for reassuring depositors, one of which was extended liability for bank shareholders. So off the books, the bank shareholders were on the hook for any unpaid debts to depositors or other liability holders. And I have a recent paper with a couple of grad students arguing that in the presence of deposit insurance, it would help to reintroduce extended liability for bank shareholders so that they wouldn't, as the bank's value of capital approaches zero, as the bank approaches insolvency. Today, the incentive is, well, let's gamble for recovery, because if we go below zero, all the losses fall on somebody else. With extended liability, the losses continue to fall on the bank shareholders below zero. So that gives them an incentive to not to play double or nothing as they become closer to being insolvent. So those sort of things, I think, can be introduced to put banks more on their own footing. And no, the banks are going to resist that kind of movement. So the benefit to banks is that high capital restrictions can be rolled back at the same time.
Okay. I also like your reference to a Darwinian view on the development of a system like this and how to reach anti-fragility. But then you also can start to wonder if you have banks and regulators, you speak about them. Isn't it perhaps so that the banks and the regulators are an efficient covariance pair, so that they are in some kind of very strong co-evolution? So you can wonder how do you loosen that, or is it?
Well, in a regulated environment, banks will evolve in a direction that it's a different environment, so they will evolve a different skill set. As I suggested, they'll learn to arbitrage the regulations, which is not the most efficient thing for them to be doing. So the regulators are a kind of, I don't know if I want to say invasive species, but if we can minimize the role of regulators, then banks will return to playing a healthier role in the economy, I think.
Okay, thank you. Now perhaps Per, if you start commenting and thinking about this.
Yes. I would like to, first of all, I think the general point here about anti-fragile banking, I think that the idea that the market, a common view among mainstream economists is that the market is stable and a self-regulating system, but then you have the financial system that is a failure. And I think this is a very good point, that the financial system is I mean, if there is no financial system, there's no decentralized market economy. The credit system is essential for production and everything else. So that if the credit system is a market failure, then basically the market economy doesn't work, and then we would be better off perhaps by some central planning. About Sweden, Larry mentioned Sweden and the enskilda banks. And this idea that the fractional reserve banking is inherently unstable. If we look at Sweden, we had fractional reserve banking for 200 years, and we've never had a single bank run. And as Larry mentioned, we had in the 19th century, we had the enskilda banks, who were note-issuing banks, who competed with the Bank of Sweden, and they held over 50% of the note issue. And during this period, not one single bank went bankrupt, and not one single depositor lost a single crown, and not one single bank had to close the window for one single day. So I think Sweden, I want to ask Larry, do we hold the world record in bank stability?
tell, yes.
Uh,
Hard to improve.
Yes. So, and since then, we had some severe crises in the 20s and 30s and 90s, and we still didn't have bank runs. You could say that in the 90s it was because the government guaranteed the banks, fair enough, but until then, we didn't experience bank runs. But yet, Swedish economists today, we all know that despite our own clean bill of health, we still believe that banks are inherently unstable, because we listen to the Americans, and the Americans say Diamond and Dugwig and the Great Depression and so on. So I don't know, shall I, how much I should comment on.
Perhaps, Ann-Marie, you can also step into the discussion, and then we have a chat around this. What is your view? You have tried to be a regulator or policymaker and also working in research and in practice. What is your comment?
Yes, I have a lot of experience in this area. Well, I mean, the title of this seminar is that has regulation gone too far? And before I answer that question, I could say that it has increased a lot. Before I entered the political sphere as a member of Swedish Parliament, I was responsible for a research project in Lund. We were covering issues that was running from financial economics to financial law. And I also familiar with all the laws that will regulate the financial markets. There were two books, I guess together this thick. And when I came back from the Parliament 8 years later, and I ordered a new set of these books, they had increased, and by that time they was this thick altogether. And during that time, I was a member of Parliament where we had the financial crisis. So there's been so much more rules and regulation on the financial market now as it used to be. When I tell my students today, if you want to have a job in the future, go into compliance, because the banks are asking, they're eager to get people in compliance. They have a lot of things to do. However, if you look at the purpose with the Swedish regulation, at least a lot of the purpose with it, that is to prevent banks and financial institutions from doing the wrong things, from doing errors. And in that respect, I would say that the regulation has gone much too far, because you can't prevent the financial institutions, as anybody or any company, to do any errors, because we do errors all the time. What you should do, and in that respect I would say that regulation has not got far enough, that is to levy more responsibility on the financial sectors, to take responsibility for the errors made. And in that respect, the Swedish regulation has not gone far enough at all, because at least the big banks are all the time rescued by the legislators and the political spheres. And that is quite easy to understand, because if I was the Prime Minister of Sweden, of course I don't want to run into a situation when big banks go bankruptcy. It's not good for my political career. So therefore, of course, I would address my focus to prevent this kind of disasters to happen. And that is quite easy to understand, that there is ties between the political sphere, the government, and the banking sector to prevent catastrophes to happen. So what's happening today, I think, reminds me a lot about when I wrote my dissertation in the end of the 70s, that is in the ancient time. And that was about the regulation of the capital markets by that time. And that was a quite heavy regulation. And the central bank or the government decided how much you could lend, to what cost, and to whom you could lend the money. And you also was decided how high the interest rate you could charge. Everything was strongly regulated. And the reason why you were regulating this hard was because the monetary policy was so badly formed. It was giant budget deficits, and the purpose was to finance the budget deficits by very low interest rates. And with low interest rates, lots of money, and people wanted to borrow a lot of money. So the government wanted to prevent people from borrowing money, and therefore you regulated the banks in order to hinder the banks from borrowing money to people who wanted to borrow money. And after some time, finally they gave up and figured out we can't stop this. Because when you regulated banks, some other financial institutions just popped up and they took care of the market. So the system was deregulated. And that was good. But the legislators forgot to regulate to that extent that they didn't distribute liabilities and rights, or responsibilities and rights in a proper way. They forgot to give the banks the proper responsibilities for what they were doing. So it didn't end up very well. So we are here again. The monetary policy is, could be described as awfully expensive with awfully low interest rates, and the legislators want to keep the borrowing low, and therefore you have to regulate the banks for not doing the wrong things. And this is not the right way to do. You should look much more properly at how to give the banks proper responsibilities. If you're doing the wrong things, you have to be responsible for what you have done. And you have to make the owners responsible for this, and also, to some extent, the other contributors of money to the banking sector. And if you don't do that, you will just continue of giving the wrong incentive from the boards, to the managers, and to the owners to do the wrong things. I have more to say, but I think that I can stop here and I can come back later.
Yes, we can come back. Larry, please come up as well. But it's really a tricky question, because it seems like we are all in agreement that it's wrong today. You should have a more liberated market and less regulation and more responsibility for the owners, and politicians should take care of macro financial difficulties and so on, and bubbles in the economy. But how do we get there? Is it possible to change the system? Can you see any sign in the US, for example, of changing the system, or are we heading the wrong way?
Well, after the financial crisis, we had a massive piece of legislation called the Dodd-Frank Act, 2,000 pages, which attempts in some ways to limit the scope of the too big to fail policy. So the Fed, during the financial crisis, notoriously singled out particular institutions to rescue, Bear Stearns, AIG, and they let others fail, Lehman Brothers. They had a special line of credit. We only found this out after the Freedom of Information Act forced the Fed to reveal this. They had a special line of credit for Citibank and for Bank of America, because they were particularly close to insolvency at that point. I would say they were insolvent, but I might be breaching American law, so I don't want to say that. But the Dodd-Frank Act has a provision which says that there can be no bailout program for a single institution. It has to be a widely available program. I guess that's an improvement, but it doesn't do much to restrict the scope of too big to fail. And in fact, the Act officially designates institutions as strategically important, or is it systemically important? It's SIFI, SIFI, systemically important financial institutions, yeah. So that's kind of, you're too big to fail in writing. In exchange for that, the regulators want to over-regulate the portfolios and the capital of those institutions. They have higher capital requirements than others, which is sort of putting together two regrettable things and thinking that it somehow balances. So we need to do a better job than that of eliminating the category of too big to fail and putting responsibility back on bank shareholders, not on taxpayers, not on the deposit insurance fund. I mean, ultimately, I would like to see the phase out of deposit insurance, but as I said, that's a very difficult task because banks have to be prepared for it. And the public has to be prepared for learning to shop around for a safe bank the way they shop around for other financial services.
Per, do you have any comment on how do we transform the system?
Well, I don't know by
Or is it
good
just that we
arguments.
should go on with these seminars and quarrel about it and say,
Yes, but what I think is important is, and Larry mentioned the Swedish, the Nordea. What I think is important for stability is capital. the capital asset ratio. And in Sweden we had 3 big crises in the 20s, in the 30s and the 90s. And at all these times, banks lost about 3-4% of their assets. And whereas in the 20s and the 30s, they were able to weather the storm because they had a capital asset ratio of 10-15%. In the 90s, they had a capital asset ratio of 4-5%. So, I'm a fan of a straight capital asset ratio, maybe 10-15%, and I think that is the capital asset ratio that would prevail in a free market. But now we have these risk-measured capital requirements that have proven inadequate. And there is also this idea that financial mathematics is a substitution for equity. There is this idea provided by Robert Merton that once upon a time you had equity as a way of protecting yourself against uncertain events. But in our day and age we have financial mathematics, and if you use financial mathematics you don't need equity anymore, so you can raise your leverage ratio. And this is basically behind, this was an idea that was behind the Basel II agreements, for example. So banks could lower the capital asset ratios if they used financial mathematics. So one intermediate solution I would suggest is to have a straight capital asset ratio of 8-10%, and then get rid of all the rest of these detailed regulatory measures.
Ann-Marie, do you agree? 8 to 10 or 15%
no.
or
Well,
something else?
I
Completely wrong.
No. I agree that, of course, it's good to raise the capital ratios. I mean, there's no question about that. But the question was that how to make this transformation happen. And now you can hear that economics are thinking in terms of models and technique. But you have to think as a politician. If you were the Prime Minister of Sweden, what's in it for you to do this? That is a point. And as an economist, we have beautiful models in political economy. But the problem is that we don't use it unless you are a researcher in the field of political economy. But even if you're into banking economy, you should think that, well, I want to go from here to here. How to persuade the Prime Minister and the government that this is a good thing to do, and that it's something in it for him, that he will promote his power and increase his chance of getting re-elected. You have to think in terms of a
And
politician.
how do you do that then? Do you have the solution?
No, yes, start to think about why are politicians acting this way? Because, as I said before, they don't want any catastrophe to happen. Many of them are smart enough to realize this might not be the right thing, but they are rather short-sighted. And a big catastrophe is absolutely the worst thing that could happen. So that is the first thing. So I want to be re-elected. I want to keep the power because I love the power. Power is beautiful. It's marvelous. So I have to do something here that is enough to persuade my voters that this is the right thing to do. No catastrophe will happen. And also we have to keep the big banks in a good mood because they are important for me as a politician. They might help me. They might do good things for me in my political career. So it's not a good thing to make enemies in the banking sector. And that is the equation that has to be solved. Exactly how to do it today, I don't know. My only recommendation is that think more in political terms, in political rational terms, and less in technical terms.
Larry.
Yeah. First, I agree with Per that in the presence of deposit insurance, there need to be capital limits to limit the losses to taxpayers. And simpler capital requirements are better than more complex ones because the more complex ones are easier to arbitrage. And before deposit insurance, banks did voluntarily hold 10, 15%, 20% capital. because they wanted, that's how they reassured their depositors that they could withstand stresses. The only thing that seems to have been effective in getting it, even the limited reforms that are in Dodd-Frank for limiting bailouts, is to shame the politicians who provided the bailouts. Right? There's a certain amount of outrage about taking taxpayers' money to subsidize shareholders and bondholders in large financial institutions, and rightly so. So politicians will respond to the demands of the public for a less cronyist, a less interventionist system that they see as benefiting somebody else and not themselves. Now, reforms that put more responsibility on the public to shop around for a safe institution, that's a little bit of a harder sell. So that sense of responsibility has to be reintroduced. And so we need institutions like Timbro to teach everyone economic liberalism.
That's what we're doing here. Ann-Marie.
Well, I forgot to say one thing, that is that politicians are not stupid at all. But they are getting so much information that it's hard to distinguish which information is the most important. And there are a lot of organizations doing a lot of lobby activities. So the politicians tends to listen to those lobby organizations that speaks in the clearest way. That's most easy to understand. And I mean, you would be surprised if you got to know how much and how active these lobby organizations are. And of course, the big banks are very active in their lobby activities. I mean, otherwise I would be very surprised. So if you want to convince that politicians there are other ways to do, you have to do these lobby activities. You have to speak with the politician. You have to speak in a terms that the politician understand, to make it very clear.
You have to read Machiavelli, perhaps.
Absolutely.
Yeah,
I
yeah.
love that book.
Yeah,
I've read
yeah.
it 4 times. I agree with him in all aspects. So it's awfully important to address your theories and your thinking not to the academic society, you could do that as well, but also if you want to have things happen and to change things, you really have to speak with a politician with the political language.
One last question before we open the floor for the audience, and a very major question is, of course, technology. Will technology change this? Will innovation, introduction of new ways of carrying out financial services change central banking and banking so that it will be more liberal, more competitive, more anti-fragile?
Well, it should. Information technology makes it possible now to have an online bank with almost no physical presence. I don't know about other people here, but I almost never visit my bank anymore. My paycheck is directly deposited and everything else can be done remotely. And so that makes it possible to have freer entry. It means that it's easier to start a financial institution if we allow it. If we force online banks to have all the restrictions that brick and mortar banks have, then we are suppressing innovation. So it's important to allow new payment systems to be introduced. In the United States, the most important obstacle right now to introducing new payment technologies that could save people a lot of money when they're wiring funds from place to place are the anti-money laundering rules. Those have been quite onerous, making it very hard for people to remit payments to their families in other places. And a lot of them came in after 9/11 on the grounds that if you can send money without somebody on top scrutinizing it, that's an open door to terrorism. Turns out that the 9/11 terrorists actually got their funds through Western Union, not through any informal network. So we're, as the expression goes, shutting the barn door after the horse has escaped, except the horse didn't even go out that door.
Per, technology.
Yeah, I also think that technology can be of great service to, for example, if we take the case of new currencies, because technology lowers the transaction costs and lowers the critical mass needed for new institutions to arise, take, for example, the case of Bitcoin, that is, according to orthodox theory, Bitcoin is the humblebee that shouldn't be flying, because in order to establish a new currency, you need a critical mass of users who are willing to put value in it. But basically, Bitcoin has a value now, and so it's technology has lowered transaction costs and made it possible to establish these critical masses needed for. But then I don't know. Then you still have it. Then you still have the regulations and the government institutions and so on. But
Ann-Marie, technology.
I don't have the faintest idea. I started my career as a student at the School of Technology in Lund. But it was impossible for me to connect cables, so I quit that. I'm not very good at technology, but I think that these gentlemen are perfectly right.
Okay, now questions from the audience, and we have a mic here. One in the back. And your name and affiliation.
Hi, my name is Daniel Samos. I work as a fund manager. I have a question for Larry. You mentioned as an idea, I think you call it extended liability for bank shareholders.
Right.
Would that work? Most banks are publicly traded companies. I mean, how would that work in practice if I'm, a shareholder of Nordea? Or do you have any ideas around that?
Yeah, so it has worked in the past. It was commonplace in the United States until deposit insurance was introduced, and then it was thought to be redundant, so it was eliminated. But shareholders are registered, and so they can be contacted if need be. But the shares are still perfectly tradable, just the new owner has to also be registered in the database. So, each share comes with this implicit liability that in a rare event, the share might have a negative value. You might have to chip in money. But it doesn't prevent shares from being widely traded. There were some institutions that had rules about who could be a shareholder so that the shares would not be all in the hands of the impecunious, so that there really was a buffer there. But institutions would typically make sure that some of their shareholders were rich, and they would advertise that fact so that they could attract other shareholders. So those kind of issues can be worked out, and today the information technology makes it cheap to keep track of these things and to contact people, so I think it's actually more feasible than ever.
Any follow-up? Okay. More questions? Okay. Sorry. There you go.
My name is Ulrike. I'm a lawyer and a compliance officer as well for a financial institute. What hits me is there's a massive regulation, and it also hits the supervisory authorities, at least here in Sweden. And that is, why do you regulate and regulate, but there's no supervision which matches the massive regulation? And I would say that you can regulate any sector, but people will do exactly what they want to unless you supervise them. It's like children, actually. So you can make laws and everything, but unless you have a good supervision, you will never, come anywhere. So I just would like to hear your thoughts about a good supervision.
Well, in a system that, say, has a minimum capital requirement, someone needs to enforce it, or it doesn't amount to much. So that's the role of supervisors. But supervision is very difficult when banks have clever financial technicians who are trying to arbitrage the regulations. So the simpler the better, and the less onerous a task we give supervisors, the better. Keep it simple, and they're more likely to be able to actually successfully carry out their tasks. But asking supervisors to scrutinize every investment on the bank's portfolio and how the covariances work, that's too much.
Ann-Marie.
I think that one answer to your question is that this is policy and politics. First of all, this is good for the finance minister to say that we're doing a lot. So we're really taking care of this managers and this financial sector doing all these bad things. And then the Finansinspektionen has its own driving forces. Of course, the responsible people in the Finansinspektion want to show their employer, the finance minister, that we are doing a lot of things. We are taking this very seriously. So taken together, it's rational for both these actors to take incentives to all these regulations. And then I really don't know what to do about it and how to handle it, because that's the next thing. The first thing is that to signal to the audience, to the voters, we're doing something good here. And then we're talking about this, you got another question about this extended liability on behalf of the owners. I think that there's another group that we haven't talked too much about, and that is the managers, because in a corporate company you have this division between the owners and the managers. And my experience says that the managers has an extreme advantage when it comes to knowledge. And the owners many times, they're not really aware what their managers are doing. And the board is not even aware what their managers are doing either all the time, because the information and the knowledge you need in the financial sector is high. And the managers has many times too little of responsibility. And in order to make a better balance, I think that you also have to levy more responsibility on the managers compared to what we have in Sweden today. And how that should be carried around, I really don't know. But I think it's important to, when it comes to this aktiebolagsform and corporate form, to distinguish that the responsibility for operative things are delegated to the managers.
Okay, Per, did you have any comment on that?
Well, I think that financial supervision, I think it could also be good for the banks, because there is this mystique around financial supervision. Government supervise the banks, and so basically people think that the bank is safe because it's supervised, and the government supervises it. And if supervision is really impossible, it's an informational impossibility to supervise banks, then banks gain from it. They can take more risks because the public doesn't consider them safe. So I think that financial supervision is good for perhaps for banks.
Mm.
If I can follow up on
Yeah,
that,
yeah.
I mean, it's instructive to ask who supervised banks before there were government boards of supervision. And the answer is in places where the banks were not implicitly trusted by the public, the banks created their own institutions of supervision through their clearinghouses. So the clearinghouses learned that they needed their members to actually pay up at the end of the day, which meant they needed to have minimum capital requirements and liquidity assurances from their member banks that they could actually settle all the checks that came for redemption at the end of the day. And that's where the first bank supervisors came from. That's where the first auditors or examiners came from. The clearinghouses trained them to go in and examine the books, not to report the business secrets of which were the profitable lines and which weren't, but to verify for the clearinghouse's sake that the assets really were there and really were worth what they claimed to be worth. And each bank submitted to that, not because they wanted to be restricted, but because they wanted a similar assurance that all the other banks with whom they were cooperating, accepting checks during the day and hoping they would clear at night, make sure they were all certified. So being a member of the Clearinghouse Association was a kind of self-organized certification process, and they had every incentive to train the auditors to do that job well, because being a private institution. They had the incentives right. And they weren't it wasn't somebody else's problem. It was their own problem if they didn't get it right.
Okay, more questions? Yes, we have one. Nice.
My name is Gustav Karskog. I'm a PhD student in economics and in no way an expert on finance. But about the too big to fail problem, as I have understood it at least, in Sweden, if a bank is too big to fail, it comes close to bankruptcy. Instead of a classic bankruptcy, the state goes in and takes over the bank. So the owners won't get anything, but we still don't have this complete system failure. And this is not the case in many other countries. You either save the bank or you let it die. Is this a good compromise, maybe? Or do you have any other thoughts?
The Swedish model in banking, is it good?
Well, if you save all the bondholders, if you save all the debt claimants against the bank, that's not good. They should also be at risk. So if they're being saved by ultimately taxpayers, then you still have a moral hazard problem.
Any more comments? I think you had a question as well, yeah?
Hi, Emma Lindqvist. I'm an analyst at one of the supervisors. Anyway,
You are one of the bad guys.
depends on who you ask, I guess. Well, comment about the supervision. I guess it's also a matter of resources. We can have David against Goliath. Anyway, my question is: we have talked about too big to fail in the sense of the pure size of the banks, but the banks today, we are highly dependent on the infrastructure that they also provide. So they're like who are providing the system that pays out our paycheck and so on. And how is, do you have any suggestion on how to deal with that in that problem? And my other question was, well, it's kind of, I understand what you say and I see what you mean when you say that the shareholders should help more responsible. But who is the shareholders? And to a large extent, that is actually the pension funds and who owns the pension funds and so on. So that there is a strong interconnectedness in the banking system that is also very problematic. And how do you think that should be dealt with?
A number of questions. Ann-Marie? Yeah.
I mean, if there are no responsibility, if you as a manager can take any risk and get a lot of benefit from taking the risks by bonuses, rewards, and things like that, and all the costs that occur as a result of your risk-taking has to be carried by somebody else, this will, in the long run, be awfully expensive. Of course, I mean, you could always argue who is going to pay for it. But I think that the most important question is to ask how to stop from this moral hazard behavior, how to prevent, I would say, managers, basically because many times the idea comes from the managers, springs from there, how to prevent the managers from taking too big risks. That is, and if you don't levy any responsibility on behalf of managers, they will continue to do that, because the upside is too big and there's no downside.
Any other comment?
I think it's a little bit exaggerated, perhaps, that banks, that owners and bank managers gamble on taking these risks, and they think that, well, if the bank gets broke, it's not my money. I think it's perhaps in extreme situations, but normally they want to. They don't want their bank to. They don't gamble with the bank going broke. I think that financial crises are basically caused by exogenous shocks that are not foreseeable, that are basically often caused by extreme monetary or fiscal policy. So perhaps I think it's a little exaggerated, perhaps, the problem with the moral hazard aspect, at least during normal times.
Can I just
Yeah,
add,
yes,
I think that if, to the extent that pension funds are owners of bank shares, they're well-placed to hire experts to monitor exactly what the banks are doing, more so than individual depositors or individual shareholders are. So that seems to me that they would, if they thought that they weren't shielded from loss, take more of the responsibility for supervising what the managers are up to.
I do agree with you perfectly that I think that many of the financial crises is caused by politicians and changing the rules, which affects the balance sheets. But the managers are not innocent in this game. And I think that it's important actually to distinguish between the managers and the owners, because many times the owners, they don't have a clue what's going on. But the manager, I met a manager for one of the biggest Swedish firms, and this is way back in the 80s. And the bank had lent a lot of money to a financial company that then went bankruptcy. And I asked him, how could you be so stupid so you lend money to that firm? You know his answer? He said, you know, if I hadn't done it, somebody else had done it. So many times it's a question about market share. And that drives the managers to show that they are very good and brilliant as managers if they could gain market shares from others. And it's not a question about maximizing profit, because you can't measure the profits. The market shares are very important. And thinking about how the idea and the desire to gain market share actually could affect the behavior of a bank, it's quite important.
Okay, thank you all. I think we should keep the time as well. You are busy people. I have 5 things that I have learned you should read to understand this and learn how to deregulate financial markets. You should read banking history. You should read Darwin. You should make the banks keep higher reserves and crap much of the financial regulation, simple regulation. And then in the end, you have to talk to politicians, so read Machiavelli. So banking history, Darwin, and Machiavelli, and then we fix this liberal reform. Thank you very much.